Hi, I'm Stefanie Wood. I'm an associate at Eversheds Sutherland.
And I'm Brian Tschosik. I'm an associate at Eversheds Sutherland.
The U.S. Senate recently ratified 4 protocols with Luxembourg, Japan, Spain, and Switzerland. These protocols amend existing U.S. income tax treaties. Although these protocols were recently ratified in 2019, some of these documents were signed as early as in 2009. In this video, we discuss certain key provisions of these protocols.
So let's begin first with the Luxembourg Protocol. The Luxembourg Protocol requires the signatories to exchange information that is foreseeably relevant to the implementing the provisions of the Convention or the domestic tax laws of each contracting state. This could include information that was previously protected by domestic bank secrecy laws. This language is also consistent with the OECD's standard language and represents a push by the OECD and the United States to increase information sharing among treaty partners. The provision could also cover non-US and non-Luxembourg persons, if those persons have a connection to one of the applicable jurisdictions, such as a bank account or permanent establishment. The Luxembourg Protocol is currently in effect, and requests for information may be made with respect to tax years beginning on or after January 1st, 2009.
The Japan Protocol updates the withholding tax rates for dividend and interest payments. These changes are generally beneficial for taxpayers. It lowers the ownership threshold to receive the 0% withholding on dividend payments and generally expands the criteria to receive an exemption on interest payments. The protocol also implements a mandatory arbitration procedure for unresolved matters. These procedures are similar to the procedures outlined in the U.S. income tax treaties with Belgium, Canada, France, and Germany. The protocol updates the information exchange provisions as well. These provisions are generally consistent with U.S. tax standards. For the withholding tax provisions, the effective dates are generally November 2019, and for all other taxes, generally January 2020.
So moving on now to the Spain Protocol. The Spain Protocol generally reduces withholding tax on payments of dividends, interest, and royalties. Currently under the Spanish-U.S. treaty, dividends are withheld at a 15% rate. The protocol allows this rate to be reduced to 5% or 0%, depending on the recipient's ownership interest in the corporation paying the dividend. The protocol also makes changes to the map and exchange of information provisions of the treaty. These changes are generally similar to the corresponding provisions that we discussed with respect to the Luxembourg and Japanese protocols earlier. The protocol also makes changes to the limitation on benefits provision. Specifically, under the protocol, a resident of a contracting state may qualify for treaty benefits if it is the headquarters corporation of a group of multinational corporations and provides supervisory function with respect to some of the members, among other criteria. The limitation on benefits provision has also been amended to include a new treaty anti-abuse rule with respect to triangular structures. The protocol is generally effective November 27, 2019.
The 4th protocol is the protocol with Switzerland. The protocol provides for mandatory arbitration procedures, similar to the procedures we've previously discussed in this video. The protocol also updates the exchange of information provisions. These provisions are similar to the Luxembourg Protocol that we've discussed in this video. It allows the authorities to request information that may be relevant to their domestic tax laws, even if such taxes aren't covered under the treaty. The provisions also cover non-U.S. and non-Swiss persons that have a connection to either jurisdiction, either through a bank account or permanent establishment.
Thank you for joining us. For more information on this and other tax topics, please visit our website at eversheds-sutherland.com.